The Fed is running its first quasi-fiscal deficit in its 110-year history.
We have a big problem, as you said, and they're guaranteed to lose money, to be liquidated.
That 43% decline in outlays, if it was continued for another few months, would be catastrophic. We're at the end of a 150-year experiment/Ponzi scheme with Western social entitlements is blowing up.
You escape one system into the next. It's not a trade.
Really? You want to sell gold and Bitcoin for dollars? Why? That makes no sense to me. It's really good for stocks. It's really good for inflation. It's really good for gold. It's really good for Bitcoin.
Knowing all of this, how should people approach this market?
You know, I think...
All right, Luke Gromen. Thank you for taking the time to come back and talk to me today. I think it's been about a year and a half. I'm very excited to talk to you today.
Has it been that long? It doesn't seem like it. Time flies when you're having fun, I guess, huh?
I think the last time we sat down was in Bitcoin Nashville, which was last summer, a little over a year ago. A lot has changed in the world since then, and some stuff maybe not so much. You mentioned that Amazon just announced some big layoffs, so AI is taking jobs. We have critical infrastructure that needs to be built in the United States. We have the dollar Dutch disease that you talk about regularly. Give us a frame that you're looking at the world through right now from a macro lens.
We are in a sort of precarious point where we've reached a stable equilibrium, I would say, but precariously so. We've got we've got the economy slowing a bit, which I think would put all else equal pressure on the fiscal situation from the receipt side. Asset prices are pretty much at all-time highs. That's helping things, all else equal. We've got, the geopolitical and trade situation in a state of flux. I think there is a dawning recognition. I think we've moved from the denial stage of grief, if you will, regarding U.S. and China relative trade leverage levels. And actually Russia and NATO relative leverage levels in Ukraine. I think we've moved on from denial, probably somewhere between the anger and bargaining stages. There seems to be this sort of bargaining stage of grief, in particular as it relates to the China trade initiatives that, we've misallocated capital for 20 or 30 years, and we've redirected labor into finance instead of engineering and skilled trades for 20 or 30 years. And somehow through hard work and magical thinking, we're going to be able to sort of rebuild that and unwind those mistakes with a minimum of disruption and pain in 1 to 2 years. And I think that is overly optimistic, to put it mildly and kindly. And then you've got this AI overlay within all of this, which is is fundamentally incompatible with our debt-based monetary system, right? We just had, last week we had a New York Times article that was an internal leaked Amazon document, but they weren't going to hire 160,000 workers they would have otherwise hired because of robots. They think that number will be 600,000 by 2033. This is the second biggest private employer in the U.S., arguably one of the most efficient companies in the U.S., arguably de facto subsidized by the U.S. government through government Amazon Web Services contracts, and yet this is what they're doing. And all of those people presumably have consumer loans outstanding as they get laid off. They all have mortgages of some description or are renting in apartments who will see vacancy rates rise, whose landlords tend to be levered borrowers in commercial real estate. And so what is right now being still espoused as a productivity miracle in AI, people are, in my opinion, right tail translating or sort of smoothing over all of the productivity gains without giving really any thought or appropriate weight, at least, to the disruptiveness of that productivity. So it's a pretty tricky moment in time where, like I said, I think we have a momentary equilibrium, but a lot of things working to destabilize that equilibrium.
So you mentioned that we have sort of a demographic problem. We have a situation in the U.S. where we don't really have the skilled workforce that we've had in the past. But then you mentioned AI, which is then being more efficient and potentially disrupting the labor force. But couldn't that also help the labor force, right? So we do have an aging demographic and we don't have as many skilled workers. And so how do we move forward in that environment? It could be dangerous. But can't AI come in and help with that efficiency?
If it does so at exactly the right pace and in exactly the right areas, yes, it could be sort of a miracle solution. The challenge, is that in multiple ways there's mismatches, right? So we don't have the grid to do what we want to do in AI per se in certain areas. So that's an issue, and we're short or will be short some of the skilled trades we need there. In theory, robots can do some of that at some point, but then you get into the as it displaces labor. If it does it too quickly, it starts to touch off a consumer credit and banking system problem where people who see their wages fall or lose their jobs because of this, they don't pay their mortgages on time, they don't pay their car loans on time, etc. That creates a credit problem, and banks have reserved treasuries per regulatory mandate as their liquid capital to sell, to paper over losses if this, whenever this gets out of hand. And one of the things I've seen in the last month or so that's a little disconcerting on this front has been a Wall Street Journal article noting that unemployment rates amongst 20 to 24-year-olds with bachelor's degrees is up to 7%. They would be the first place you'd see this because, AI is, sort of that's who it displaces first. Are your least experienced, sort of accredited workers, right? Degreed workers.
Right.
And you're starting to see it. And if you applied a 7% unemployment rate to across this economy, like kaboom, it doesn't work with those numbers, let alone 8%, 10%. Or, heaven forbid, we had a productivity miracle when China came into the WTO, and we lost a third of manufacturing workers in this country in about 4 or 5 years. If something like that happened across certain white-collar sectors, Katie bar the door. And that's why I say it's fundamentally incompatible if it arrives too quickly, and it appears to be arriving too quickly.
So it's more of a displacement issue. When you look back through all the technological revolutions of the last couple 100 years, each one does get rid of a lot of jobs, but then it creates more jobs than have been lost. Things don't operate in a vacuum. So all of a sudden it creates more demand in areas we didn't know about, but there's that bubble, that displacement bubble we have to get through. But it looks like something you've talked about quite extensively is what happened in the Rust Belt, right? So with China coming into the WTO and all the jobs going over there to China that sort of hollowed out that industrial base, in the Rust Belt in middle America. I would say, like, one, I think that happened. Number two, though, we went from an industrial era to an information age, right? And so we went from assembly line to now working on IT, information systems, et cetera. Isn't it sort of part of like a society as it advances to sort of get rid of the lower level tasks, picking cotton in the field, making textiles, for example, and then maybe even manufacturers to keep moving to the higher level things? So was it more, I guess, was it both of those? To me, it sort of seems like it was technology that disrupted those middle America workers more than wanting to offshore them because of the dollar, the need to offshore dollars.
You've heard me talking about investing in layers and things like the reason you have to work so hard is because your money doesn't. Well, I want to invite you to a special event I'm having, a 3-day live event called the Wealth Operating System. It's an accelerator event where I'm going to teach you all the tools that the 1% use to have their money work harder than they do, getting their money to do 1 job, 2 jobs, 3, 5 jobs at once so it can work faster and harder than you. Over 3 days, we're going to go deep. I'm going to bring in guest speakers. It's workshop style. I got about 15 tools, and we're going to go through a methodical process so you can learn how to reclaim 10 to 15 hours of your time back per week, how to keep more of your money, how to invest it and multiply it faster than you've ever imagined. And by the end of it, you'll have a 90-day plan of exactly what you need to do to go make 2026 the best year you've ever imagined. It's all going to be live. It's all going to be virtual. There's a link down below if you want to come check out. I'll put a QR code up on the screen. If you want to get your money working harder than you do to grow your wealth faster than you've ever imagined, like the 1%, check out the Wealth Operating System Accelerator event. Check out the link down below.
Yeah, I think that kind of thing has happened, and it is, when I look back to, say, prior technology booms, right? So go back to the late 1800s, we had railroads, and we had, cars, and you had the discovery and commercialization of oil and fossil fuels, and then, you come into 1914 and you have 4 major empires, and by 1918, 3 of the 4 are gone and dead, and and one of them's mortally wounded, and has basically ceded its reserve status to America in the aftermath of it. And so it's not to say this kind of thing hasn't happened before. It certainly has. And, when you look at, say, okay, had this conversation with somebody the other day, and they said, look, they called up Grok. Hey, Grok, what was, sort of, the boom associated with that? And I said, well, hey, I replied by saying, hey, Grok, what percentage of the human population in the world in 1913 was killed in wars and political revolutions due to the fast pace of socioeconomic change from 1914 and 1945? And Grok said, about 100 million people, and that was equivalent to roughly 5 to 6% of the population alive in 1913. And what I didn't then ask Grok is say, hey, what percentage of that was of Eurasia, since most of those deaths were in Eurasia? And it's probably closer to 10 to 12%, right? So it's one of these things where, yes, over time, these technological shifts inevitably move human progress, intelligence, etc., higher. The challenge is, A, it's nonlinear, and B, we've never done it with debt to GDP in post-war levels. It's all, we've always been at pre-war levels. So we're at post-war levels of debt to GDP. And the other thing we have is that we're at the end of a 150-year experiment / Ponzi scheme with Western social entitlements is blowing up. Right? If you went and said to the average investor, and as you know, we wrote about this last week, was when you're in a Ponzi scheme and people start taking more money out than are putting money in, 100% of those Ponzi schemes have blown up. And that's what's happening in Western social entitlements, and has been for 10 years. And there's like this magical thinking that, well, this won't blow up. Like, everyone knows it'll blow up, but everyone's sort of hoping it'll blow up on someone else's watch. And the reality is that as fast as it's blowing up, AI is going to make it blow up way faster. Like, it will, they think it's going to run out in 2031 or 2032, one of the funds. AI, well, what if AI makes it 2028, 2029? Then what? And to me, it's ultimately all about, well, the Fed's going to have to backstop it. They're going to have to more fully reserve all this debt, because ultimately their mandate is backstop the banks, and this will take the banks down.
And when you talk about entitlements, you're talking about Social Security, Medicare, Medicaid, those types of things. And you've talked about that the government can't print healthcare, right? They have to pay for those services. That's money that's owed. So it's a good frame to work from. So we have this situation where AI is disrupting. We have this aging workforce. We have debt to GDP, to your point, extremely high, over World War II levels. And then what do we do about it? So we saw Elon Musk come in with Doge, or he's going to change the world. He left saying, okay, there's no hope. We can't cut spending. We have to grow our way out of it. Scott Bassett said we have to grow our way out of it. And now it looks like reindustrialization, drill, baby, drill, pro-energy, and grow our way out.
Yeah.
I was going to say, and that doesn't happen without a bunch of government intervention and spending.
You're going to have to run it hot. You're going to effectively have to either explicitly or implicitly do some form of yield curve control, because otherwise interest rates are going to rise and more than offset any of your initiatives, right? So we've started to see the government appears to be cognizant of this, right? We've seen Besant say it, we've seen Trump say it, we've seen Musk say it, and that sounds good. But they're still not saying the quiet part out loud, which is, who's the sucker at the card table that's going to hold the 10-year paper at 4% when we're growing the economy 10 or 12 nominally, or 15 nominally, with 5% real and 5 to 10% inflation? And there is no private sector sucker at the table that will do that. That will have to be regulated into, and we've been doing some form of that for going on 10 years in terms of regulating banks, regulating money funds, regulating pensions. Trump's 2018 tax cuts provided for a tax incentive for U.S. pensions to buy more treasuries. So they've been doing these kinds of things. But by virtue of the fact that debt to GDP is still higher post-COVID, they haven't worked. It's not been enough. It's got to be more aggressive. And so, yeah, I mean, it's ultimately about significant financial repression. Right now, we're sort of still in this bargaining phase of grief about it, that, we can grow our way out of it, and we can work really hard, and we don't need to crush bondholders, the real value of their bonds. And that's just a lie. Mathematically, it's impossible. So, but the challenge is, like, the second they say that, the bond market's going to revolt. And so they sort of need to try to boil the frog slowly, while also moving more quickly, because, China's moving faster and the debt continues growing and AI is accelerating, putting more pressure on it. It is an unenviable situation in which they find themselves. And ultimately, I think it's, we started to see more volatility in certainly gold markets, other markets in recent weeks. I think it's a much more higher volatility sort of baseline. And I think it's really good for stocks. It's really good for inflation. It's really good for gold. It's really good for Bitcoin. It's probably continue to be good for certainly certain types of real estate, hard assets. And I think it'll be good for wage earners, but I'm not sure it'll be good for sort of white collar. I think might see a reversal of what we saw from 2001, from 1982 to 2020. I think the next 40 years might be really good on a relative basis, certainly, for wage earners, skilled trades, engineers, etc. Even if they're prompt engineers, as it relates to to Chat GPT and AIs, but running it hot and repressing bonds is the only way out.
So it seems like that is the only option that they have, at least the only option that anybody's going to stomach or bear. But at the same time, it seems like, well, you mentioned that when we started that assets are basically at all-time highs. It seems like Bitcoin hasn't really been responding like most people think it would. Gold's kind of stealing the show. What's your take on that?
Every day we see headlines about inflation and debt and diminishing control over our own money. That's why I always come back to Bitcoin, because it's built for generations. It's built for legacy. But protecting your Bitcoin legacy the right way, it's not always simple. It demands discipline, focus, and the right partner. Now, that's why I personally use Unchained Signature. It's a premium private client service for serious Bitcoin holders who want expert guidance, resilient custody, and an enduring partnership. Now, with Signature, you're paired with your own dedicated account manager, someone who understands your goals, helps you every step of the way. You're going to get white glove onboarding, same-day emergency support, personalized education, reduced trading fees, and priority access to exclusive events and features. Unchained's collaborative custody model is designed to provide the same security as the world's biggest Bitcoin custodians, but for those who prefer to hold their own keys. Now, I've been using and recommending Unchained for years. I even got my parents to set up with them. So if you want to get set up, check out Unchained Signature at unchained.com/MarkMoss. And as a loyal listener, I got a discount for you. Just use code MOSS10 at checkout to get 10% off your first year, because your Bitcoin isn't just for life, it's for generations.
I'm of a couple different minds. My base case is that we've seen this pattern where, sort of gold goes and then Bitcoin goes, and then gold goes and then Bitcoin goes in the last few years. And I think it's maybe that. I also think part of it is, particularly amongst shorter term traders, Bitcoin is traded with NASDAQ increasingly in the short term. And, the NASDAQ, for a number of different reasons, has kind of been range bound through much of the summer. And I think there are there's reasons to be potentially secularly concerned with the NASDAQ, or certain high flying parts of it, right? Can China win in AI, right? Right now, someone showed me an AI leaderboard the other day, someone in that world, and they said, hey, for what it's worth, this is based on what are supposed to be objective metrics. Top 10 AI platforms, half of them are Chinese, half of them are American, right? So, like, you're spending hundreds of billions of dollars in capital in this country to build that out. What happens if China does to AI and the NASDAQ what it's done to sort of every other industry in the U.S. that it has attempted to do that to? I suspect some concerns around that, some concerns around the capital intensity, et cetera, are weighing on the NASDAQ. Some of the trade war has as well. So I think in the short run, some of what is holding Bitcoin back has just been that, that short-term view that, well, Bitcoin is just NASDAQ, a high beta version of NASDAQ, up or down. And so if NASDAQ's not ripping, there's no reason for me to get involved in Bitcoin. And, there's something to that. Over time, of course, if you go back 5 years, 10 years, they are still very They rhyme, but Bitcoin has crushed NASDAQ, right? So, and I still think that'll be the case. But I think those are kind of, and I guess I would layer on one last one, which is, we're to the end of the 4-year cycle on Bitcoin, right? So, 4 years ago was end of 21. We sort of had that last little blip up into the 60,000 range. And then, 2022 was sort of, kicking the crotch after kicking the crotch for Bitcoin holders. And 2017 into 2018, same thing. 2013, 2014, same thing. So I think there's a lot of people that are very cognizant of that and are skeptical that it's different this time. And I think that's a reasonable, view. So I think sort of the combination of all those three things are probably, drivers to the reason why Bitcoin doesn't seem to be responding. Let's see. I'm still seeing, I would feel a lot worse about Bitcoin sort of being range bound if I was seeing people telling me, what I'm saying, which is like, they're going to have to repress this thing so much, and there's no way they're going to be able to win against China without running this thing super hot. I'm not seeing that. I'm still seeing a lot of bargaining and wishful thinking and sort of, idea machine, as one of my friends calls it, right? It's like, well, we'll just, we're going to mine all our mines. It's like, okay, great. Where are you going to get the turbines? We don't know. Well, the lead time on turbines is 3 years. Okay, well, how about the permitting? Well, we're going to get that. That's normally 4 to 5 years. Oh, well, okay, well, we're going to build a rail yard into those mountains. Great. Where are we getting the steel? Where are we getting the welders? Where are we getting the engineers? Are we going to take them off the AI programs? Or are we going to leave them on the AI program and bring in foreigners that you just close the border on? So there's a lot of the idea how to do it. That part's easy. There's an executional side that is being sort of, smoothed over by Washington and Wall Street that I would sort of summarize as, other than that, how was the play, Mrs. Lincoln, right?
Right.
Other than the fact your husband was assassinated at the play, how was it? Well,
Great.
that's the whole friggin' thing, right? That's,
Yeah.
if you can't execute and put this order of operations together, so let's see how that plays out when it comes out. And I think it is a win when it comes out that this isn't going to get fixed in a year or 2 or 3 years or 4 years, that this is, hey, we're going to need to do 10 years of really aggressive investing in inflation. Look, if Bitcoin's down or doesn't do anything on that, that's probably going to force a rethink on my part and a lot of people's parts. But
Right.
until I see people telling me that, I remain bullish.
Well, to your point about it sort of trading with NASDAQ and looking at it as sort of like the speculative play, I mean, JP Morgan came out a few weeks ago and called it the debasement trade, talking about gold and Bitcoin being as the safe haven from debasement. So rather than sort of people looking at it more speculative, it seems like mainstream or TradFi is coming around to it being more of that safe haven asset.
Yeah, I think that's right. And, I think it's an important sort of signpost, as I like to call them, along the way of, we've gone from traditional finance saying it's, whatever, rat poison and whatever they want to call it, a Ponzi, what have you. Now it's part of the debasement trade. I think that's a huge step. I don't think it's far enough, because I think ultimately where we are, there's no debasement trade. This is a debasement trend. We are into fiscal dominance. The Fed is running its first quasi-fiscal deficit, which is just a fancy way of saying operating loss, in its 110-year history. Once Brazil started running quasi-fiscal deficits, once Argentina started running quasi-fiscal deficits, gold and Bitcoin went from sell the rip, debasement trades, to buy the dips, debasement trends. And I think that's sort of where we are, where there's still this view is like, okay, well, I'm going to have to get out and at some point and, sell Bitcoin, sell gold for dollars. And for a trade, sure, but really? You want to sell gold and Bitcoin for dollars as we're talking into this setup? Why? It makes no sense to me. And so I think that's still on the come. People will come to that.
I think of the book When Money Dies, and they talk about how people sold all their assets for dollars because they were at all-time highs. And at the end, they burned the money in the fireplace that was worth less than the wood was. And so it's like you escape one system into the next. It's not a trade. It's like you're leaving one to the next. But you mentioned that the only real way out is through financial repression, stealing from bondholders. I think the largest market in the world is fixed income, over 300 trillion, about 145 trillion of that is fixed or securitized tradable fixed income. You have the demographics, so you have this aging population that needs that income. How much have you looked into what Michael Saylor's doing with the preferred strike, stripe, stride, and now specifically stretch by taking Bitcoin and stripping the volatility off of it and offering that digital credit, that yield off of the digital asset?
I've not looked into it a lot. I should. That kind of thing would make a lot of sense if you can sort of, engineer that into an instrument. That would be very good for Bitcoin demand, obviously, and would help people in that position, right? Where, because you've got retirees who own a disproportionate percentage of those 300 billion or 300 trillion, excuse me, or whatever bonds. And, the other side of that is, here in the U.S. alone, they're the ones owed $120 trillion in Social Security, Medicare, Medicaid, right? So you're making repressing them is making the people who owe the money. And yes, they've paid into it, but they haven't paid in enough for what they're taking out. Otherwise, it wouldn't be blowing up. It's basically a tax increase on the people who are using the goods. The challenge is that, if they have to start selling stocks to pay for that, the stocks de facto back the Treasury market through the government receipt and the consumer spending. So that you can't have them sell down stocks to help fund that. You've got to keep all assets up or else the whole thing comes unwound. But yeah, in theory, something like that would help. I just haven't dug into it as much.
Yeah, I mean, we have a big problem, as you said, and they're guaranteed to lose money to be liquidated. And so they're going to have to find an alternative. So anyway, it's worth doing some digging into that. I think it's pretty interesting. So knowing all of this, the inevitability of this, how should people approach this market? Maybe kind of break it down, maybe by age, demographic, or time frame. But what should they be paying attention to and kind of positioning for?
Governments will never stop printing money, so inflation, it's not going away. Now, if your money's not earning at least 10% a year, you're losing purchasing power. Now, that's why I talk about Bitcoin. It's the number one way to beat inflation and secure your future. And the question I get asked almost every day is, where do you buy your Bitcoin? Now, for years, I've personally used River.com, and I only take on sponsors that I use and I trust. And I trust them because River's Bitcoin only, they have 100% reserve, and they keep your Bitcoin safe in cold storage with no middlemen. And you can actually talk to a real person, a US-based support dedicated manager. Now, try getting that peace of mind from Coinbase. Of course you can't. Now, the perks, if you set up auto buys, you can pay 0 fees. Plus, instead of your bank paying you, 0.4% on cash, River pays you 3.75% on cash paid in Bitcoin. So if you're ready to build your Bitcoin position with confidence, go to river.com/markmoss and get up to $100 in Bitcoin when you sign up. Because freedom starts when you own your money, and your money starts with Bitcoin.
I think one of the wiser allocations I've seen, it was something inspired by a man named Jacob Fugger, Fugger. I think he was Dutch. Way back in sometime in the Middle Ages, he was a merchant. And by share of the economy, he was one of, if not the wealthiest man in history. And what he advocated was 25% gold, 25% cash, 25% real estate, productive real estate, which, farms, timberland, etc. And then 25%, I think he said government bonds technically. I would put that not in government bonds, but I would put that in high dividend, dividend paying blue chip equities. And then rebalance when you need to rebalance. And I would say of the 25% in gold, I would split that with Bitcoin, depending on your age. If you're younger, I would probably, and have more of a tolerance for higher volatility, I would probably have more than half of that in Bitcoin and smaller in gold. And if you're older and closer to retirement and less of a stomach for volatility, I would have that more in gold and less in Bitcoin, maybe just a sliver in Bitcoin, capture and participate some of that upside. And if I was older and closer to retirement, I would probably put some of the 25% that are in equities and put them into, some portion I would put into high grade corporate bonds. I wouldn't put them in long-term government bonds. I just think I would much rather have, I think at some point in this cycle, you will see high grade U.S. corporate bonds trade through, as they would say, similar tenor government bonds. I'd rather own a Microsoft bond than a U.S. Treasury. They're both going to get paid. I just think it's I think that's how they're going to trade. So That's what I would do. And Ray Dalio's all-weather portfolio was inspired by Fugger's allocation. But I think the key is really having balance because we are just off the reservation in a number of different directions. I mean, this could break severely deflationary. It could break severely inflationary. It could not break. It could muddle through. It could, there's, if anybody tells you they know how this is going to go, like run in the other direction. And certainly me, like I am no seer. Like I don't know how it's going to go. I want to have sort of balance across that. So that informs some of how I'm positioned, and I think it's a wise allocation for the world as it is today.
How could it break deflationary?
For deflationary?
I don't know. To deflationary. I don't know if there's any precedents ever that I've ever seen where a government says, well, it was a good run, pack it up, boys, let's just stop. Right? I've never seen that. Every nation takes it until it doesn't work anymore, right? Diminishing return. So what would it look like for to break deflationary?
For it to really break deflationary, to your point, it has been the most rarest of things, and it's only been temporary. When you control the currency, when you print the currency, they never choose deflation. It would have to be some sort of, pandemic / die-off, probably, right? Where, there just isn't not only there isn't the demand, but there isn't a productivity driver to accelerate relative to that, right? I'm trying to think through this on the fly, but if you have population decline, but productivity advances faster, then you can in theory improve, maybe improve living standards, but I'm not even sure that's the case. I'm thinking back to like the Great Plague, right? A quarter of the population in Europe, or 30%, died. Yes, you were probably on some sort of gold standard. I'm not that familiar with it, or metallic standard. At any rate, you end up with a deflationary scenario where, but even then, certain things, right? It was deflationary for the landlords and their properties and houses and rental rates, but it was very inflationary for labor, right? Labor all of a sudden had power. It was margin compressed. So,
because
to your point, it's very difficult unless the government just stands aside and just says, yeah, we're defaulting and have a good day. But even then, that's only going to be for a bit because the debt backs the currency. So it's only going to be for a little bit, and then you're going to have hyperinflation.
So when we're thinking about long term, we're trying to gauge the percentage of probabilities. And the probability of that happening is extremely low and really would be a policy choice. Because right now, in financial fiscal dominance,
you would run into
the government running big deficits, they're essentially pushing the economy. So they'd have to have a policy choice to stop that. And we'd see that coming. We'd see the appetite wane. We'd see lawmakers fighting, and we'd kind of see that happening.
Yeah, I think that's right. It's interesting when you bring it up that way. The U.S. government spent 43% less in September than it did on average the prior 11 months, right? So it spent $346 billion versus an average of $603 billion a month of outlays the prior 11 months of fiscal 2025. And of course, Scott Bessent got on X and bragged about his $198 billion surplus, which was aided by a $107 billion negative outlay, which I think was a reversal of an education, a student loan accrual. But I would love to pay my taxes with a negative outlay. That would be fun. Like, I'll just send you guys a negative outlay and don't touch my bank account, non-cash.
Yeah.
But the point here is that 43% decline in outlays, if it was continued for another few months, would be catastrophic. It would be catastrophically deflationary. What's really interesting in this is the 10-year Treasury, with that amount of a monthly decline in outlays, that it only went from 4.25 to 3.95 or 3.97. Like, that's really something. That's actually very troubling. Like, if I owned long-term Treasuries and they could cut spending for a month by 43% and all I got out of it were 30 friggin' basis points on the downside, that's not really encouraging. I mean, that really speaks to your point on fiscal dominance. So, look, maybe if they kept doing it for another month or two, maybe they could get the yields down a bit more. Maybe it would definitely be deflationary. But then again, because the federal government is 23% of GDP, the federal outlays divided by GDP is 23%. So you cut that by 40% for a few months, you're going to be running GDP down 9 to 10% on a run rate basis. By way of comparison, the full year GFC was down 3 or 4. By way of comparison, shutting down the economy for COVID, it was down like 8.5. So you would be like literally tanking the economy. So you can do that for a second until, you would run into what we've run into, which is the Treasury market dysfunction. Yields will start going up in a recessionary environment, and then they're in a death spiral. And then to your point, like, what do you want to do? You want to stand aside and just let this thing go into the ground at 500 miles an hour? Okay, but that's never how it works out. They come in and, they print the money one way or another.
So they have to print the money. The debt keeps growing faster and faster. The rates are making it unsustainable. I want to probably try to wrap this up. Let me ask you to make a prediction for me. Not a price prediction. Trump has said he wants rates to be 1%, I believe. He thinks that's where they should be. Trump seems to
2%?
I thought he said 1%.
1%? Okay, yeah.
I think Trump said he wants rates at 1%.
Yeah, I think that sounds right.
He typically kind of gets what he wants. He's going to replace Jerome Powell next year. Where do you think rates are maybe at the end of next year or the end of his term?
If he gets rates at, you're talking about Fed funds rates. If he gets Fed funds at 1, could get that. I wouldn't be surprised if he got that. To me, the $64,000 question then is, where's DXY? Where's gold? Where's a 10-year? If he has rates at 1 by the end of his term, I think DXY's low 80s, high 70s. And I think the 10-year, I think gold is probably $7,000 to $10,000 an ounce.
Wow.
I think Besant has revalued it from 42 to whatever that number is and put multiple trillions of dollars into, $1.5 to $2 trillion, maybe up to $2.5 trillion into the Treasury general account, and significantly curtailed long-term Treasury issuance. So I think the 10-year, if Trump gets his 1%, I think DXY's, 75 to 85, and I think gold's 7 to 10,000, and I think the 10-year yield is at, where is it today? 4? I bet you the 10 years at 2.5, 3, because ultimately I think they're just going to curtail issuance so greatly, and there's like this mindless bid for duration of whatever it is, 400 billion a year, 500 billion a year from duration matching. I could see that. And that's essentially de facto yield curve control. With the dollar weakening that much, it's going to be massively stimulative. Nominal GDP is probably pretty good. How they reinvest depends. How our foreign partners reinvest, it depends. I could see that. That's if he gets his 1%, yeah, that's what I would say. I'd say 1% Fed funds. I'd say, what would I say, 2.5 to 3 10-year, and $7,000 to $10,000 gold, and 75 to 85 Dixie.
All right, you heard it from Luke. I nailed him on a prediction. No, I think that's great. I think he gets what he wants. It's going to be interesting to see how that plays out. I'm gonna use that as a good time to break this thing off, Luke. I appreciate your time today. As I said, one of the main newsletters I read every single week, Forest for the Trees. I'm going to make sure to link it down below. Everybody should read it if you want this amazing research. Anything else you want to point to, Luke, that people should pay attention to?
No, I think that covers it. I appreciate the shout out, and always enjoy chatting with you. And I think it's going to be hopefully fun, but certainly an interesting end of the year. So let's watch.
Yeah, good. All right, we're going to end it with that. Thanks so much.
Thanks, Mark.